Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary entitled Preparing for the Recovery. Markets have been strong this week. Indeed, they've been strong for the year to date, with US and European indices up 3% and Nasdaq up by a whopping 7%. Indeed, US indices have pretty well hit record highs as I'm speaking. UK gilts have also seen yields rise sharply as they have around the world, the UK 10-year touching 44 basis points, as investors sniff a stronger than expected recovery for 2021. Why is this? Well, we expect Biden's spend it big $1.9 trillion package probably to be forced through the Senate by a process of reconciliation. Secondly, we expect corporate earnings to be a little bit stronger than expected in Q4. The numbers are coming in well. And thirdly, of course, vaccine rollout news is positive, especially in the US and UK. Underneath this slightly more benign outlook, of course, there's turmoil. Equity volatility is high. The Reddit message board stocks have surged up and contracted. And this battle between value and growth seems to be flip-flopping and reversing day by day. What do these contradictions mean? What do they mean for policy? And what's our outlook for 2021? That's what I'll cover in the slides ahead. So let's begin with the current situation, the economic outlook, and you can see the dichotomy. On the one side, fund managers are very optimistic about the future. If you look at the data from the Bank of America Merrill Lynch Fund Manager Survey on the left, they ask the question, do you expect above trend growth and low inflation, i.e. a good economic outlook? And they got their second most positive reading in the past decade, so optimism is there. This contrasts sharply with our global stringency index, which we've looked at in previous recordings. That shows that lockdowns, particularly in Germany and the UK, are among the tightest they've been, even allowing for the period, the dark days of March, April 2020. What's going to determine which of these views is right? Well, first of all, the COVID infection data. And here the numbers are definitely encouraging. Look on the left-hand chart at weekly cases per 1 million people and see those sharp declines in the UK in blue and the US in yellow. Equally encouraging on the right is the speed of the vaccine rollout programme, an extraordinary 15.5 people per 100 vaccinated now in the UK, a huge programme rolling out in the US, and at last Europe beginning to accelerate. This needs to be put in context of other vaccine programmes, and the data service Our World in Data shows the year in which a pathogen was discovered and the gap between that and the vaccine arriving. And you can see these huge multi-year, multi-decade sometimes development periods. And then you go down to COVID-19 and we're measuring it in months. The second factor that's going to be determine how markets react to this recovery is how inflation behaves, and whether that triggers a further backup in bond yields. I've used US inflation here, and you can see the CPI, the core measure in blue, the headline measure in red. And you can see that spike, which we're going to see. We're beginning to see it already, higher inflation data in the US and Europe. And you can see that spike, which is primarily base effects and primarily the effect of the recovery in the oil price, which you can see in the dotted line below. Whether that triggers longer-term inflation effects is probably less likely. Why do we feel that? Because coming out of a recession, you tend to get a hike in productivity, a fall in unit labour costs as firms get more efficient. You can see that on the right. This is US unit labour costs. The grey lines are recessions. And after each recession, you can see that blue line dropping, unit labour costs falling. So I think it's quite hard, in the short term at least, to push inflation numbers up consistently if you've got those lower than expected unit labour costs. The third effect, of course, is whether we're getting bubbles, and this is a big and long topic and has been the headline of newspapers as they've looked at these Reddit stocks and message board stocks, GameStop, BlackBerry, etc. How are we reacting? Well, first of all, there is excessive exuberant behaviour in the market, there's no doubt about it. On the left, I've shown the famous US put-call ratio. This shows the percentage of people buying puts, they're defensive, versus calls optimistic. And you can see that the chart in favour of calls, that's the lower blue bars, were almost at decade lows in the last few weeks. On the right-hand side, I've just put the crazy moves in the market capitalisation of GameStop and BlackBerry. GameStop rising from just a couple of billion market cap up to 24 billion market cap and back down to 3.73 billion. I think, though, these are isolated events. Yes, retail investors are spending their accumulated savings on aggressive market participation, but it's not hugely altering our market outlook. So let's look at market returns 2020 to date. The dark blue line, the World Equity Index, climbing an almost straight line from those April-May lows last year, rising an extraordinary 17% for a UK investor. Gold returns in yellow, fading as economic confidence improves in the world economy, and UK gilt returns lower also on those slightly higher yields I mentioned earlier. Look at the light blue line there at the bottom, that UK equity index, still the clear outlier to the downside of all world markets. On the right-hand side, volatility well off the peaks we saw earlier in the year, but still stubbornly above the 10-year average, reflecting some of the turmoil in retail stock buying. So what does this mean for our policy? We're still clearly underweight bonds, both government and credit, where we see yields gradually creeping higher in the months ahead. We're overweight equities, both global and importantly emerging markets, which have been strong recently, and the UK, where Bloomberg is reporting that valuations relative to the US are close to 30-year lows, and we believe investor flows are returning. In alternatives, we continue with our clear overweight, particularly concentrating on renewables and infrastructure, where we see the green agenda powering long-term returns. We're funding this with an underweight cash position. Well, I hope that's clear. I hope it gives you some idea of our long-term priorities relative to the short-term volatility, both economic and market. Thank you.